Levels, 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 right? Levels. Those are where you identify a great opportunity, but how do you find levels, right? Like for example, as you know, that do provide pre-market plans, zones of interest every single day on the Substack. This is a continuation of the initial video of the two strategies that I implement to find trade opportunities. Now, we're going to be dissecting it from the very essence of it all, of how to even discern or create a plan. First and foremost, the fundamental building block of it all is finding the levels of interest, right? Once you can formulate the levels of interest, we can tie it into the next segment of video, which will entail price structure or what exactly to look for around these levels. It's not just, oh, there's a level, you buy it. No, okay, there's other things that are tied to this, but this is the first foundational part of identifying a good strategy. It is finding an opportune level. As you can see here, I had given this zone of interest of 57.35. This is from September 20th, yesterday, Friday. I gave that zone of interest as part of a pre-market plan from a prior day. Right here, right? We were trading. I give some context and whatnot, right? A little preface, but the zone was 35 to 27, right? That zone, that level. There's some always going to be context given as to why that level, because every level has a meaning and every level has a reaction, and the reaction is correlated to a lot of different little contextual reasons why that zone is of interest, right? So 35, this is today's Friday's action, how it played out after the fact, right? This was before the price action occurred. We were trading at 57.63 at the time of the plan put out. We dropped 30 points from that plan zone, and lo and behold, 35 was the area of interest. Reclaim was the trigger, and then the 40-point move, about 30 to 40-point move, was the result of a predetermined plan at a given price level. So let's dive in and find out how to get those bad boys. Now, before we can even dive in and then decide, you know what, this level is of interest, we need to understand why a level even captures my attention personally for my strategy. And it is always the origin of the move from that area, right? The origin of the move could be in opposite direction of the way I'm looking to trade it or in direct correlation to the area I'm looking to trade it. It's always based on a reaction. What we'll do is we'll go into the ES chart and I'm going to reverse engineer why the 30 was important to me, that 35 zone, and then kind of work forwards on how we other factors that also gave me reasoning why this 35 zone was of interest. Because it's just first it's the reaction, then there's other contextual reasons why I like it, right? And the more confluences to a level that I can pinpoint and provide, the more confidence I have in the zone to even make it a part of a plan. So I'm not just picking a level and then just deciding this is the zone. It's always, okay, this zone is good because X, Y, Z, W, A, B, C, etc. Right? The more confluences the levels line up, and I'm going to explain those confluences, the more theoretically I have confidence in this plan, which then makes it as part of one of my scenarios that I share with you guys every single day. And if there's ever less confluences, so say I like the 5750 and I only have two reasons why that level is of interest, that I can find contextual reasons to like the level, then it's going to be on the back burner. It's going to be a secondary plan that is of interest, of course, but will not have a higher quality, high conviction trade expectation, right? And I explained those as well. I gave that same example here in the second scenario, right? I said given the move, I gave the zone of interest, which was, sorry, this is for actually the new one. Oof, can't be giving away free levels now. This is the prior zone, 5750. I said this trade is lower quality, right? So a lower quality trade would entail not much size, not much expectation, and also lack of follow through is expected if it works, right? So I do grade these levels based on parameters, and I'm going to explain those. If you guys want more condensed information, just like as you're taking a poop or sitting in the restroom, rotting your brain with useless information and want to get some value while you scroll through the internet, follow me on Twitter. I dissect and discuss different topics of breakout trading, consolidation, market mechanics in a very condensed fashion with illustrations to make it fun. So make sure you all follow me at TradeWRick on X. All right, now make sure you stick to the end because there is going to be some golden nuggets there given final segment that is event-based levels and why they're so meaningful. I give kind of context as to why event-based levels are an extra layer of confidence, or a magnified reason why those levels are very, very much more higher probability. All right, so now we're gonna discuss the levels, right? So we're gonna reverse engineer that 35 level and kind of how I came to it. Okay, because this video is all about levels, right? So number one, reaction. That was the first segment, was reaction of the zone. So let's just get a new clean slate here. We'll put YouTube as the clean slate here. And what we're going to do is, if I was here just looking at this, first of all, I zoom out, of course, right? Maybe 1 hour. It doesn't really matter, essentially, as long as you get a bigger picture view, right? What I want to see is, like, is there a level of interest, is there a zone that has resulted in a magnified move? Again, none doesn't have to be in favor of the trade I'm looking for, but just a magnified directional move up or down. And if you go back, that 35 zone to 27, it lines up with so many confluences, which is why I like the trade or like the zone. Number one, reaction, right? We can see in the most immediate way, the reactional move, that's my first filter, we had from that zone was right here. We rejected a couple times. We rejected once, and then again on FOMC. It's another layer of confluence. I'll get onto that later. And then once we held above it overnight, we it resulted in a magnified move up and down, right? So first left to right. So that's how we read here in the U.S. and other countries may do it differently, but this is an English video. So you can see here that we had been trading at 27. That was the zone, generally 27 to 35, right? The high there was 35, give or take a few points. And that move had resulted in, say, let's just round up for simple reasons. I can't do complex math in my head. So 57.30, and we sold. The reaction was, let's just do it to the base. We're just rounding here, right? 56, let's just say 57, 56.90. The move there was pretty magnified, right? We had a pretty rotational move. We broke a prior day range or prior day high as a result of trading at that level, right? That's number one. That draws interest. Now we go back forward and we go, okay, well, has that happened before? Again, was there another instance in where that level had a magnified move to the downside? We're going to zoom in a little bit more just because that FOMC action was a little bit condensed, and you can see a lot of wick action. You can see that 27, same zone around, same fragment of price. We had another reactional move a few times when we traded there, right? You saw a reaction down about 20 points. And then the tip of this one was another move down, all the way down to 80. So another big magnified move within the same zone, 80. And then yet again. So this zone more or less is constantly rotating, trading, getting above or below or at the zone generally. And then, you're getting even more and more moves up or down. It doesn't matter, okay? The magnitude of the move is what really entices me, because I know that if I capture that zone in the right direction, up or down, my risk to reward is favorable, right? If it's not a long, then it's a short. But that's why context is important. That's why forming a plan is important. But right now, levels. And so we see that happen twice. We even see it in the overnight session. So if you go even to the overnight session, you saw that the high there was 30, 27 was the neck, or the essentially the midpoint of that move, and we dropped down to 5,700. So another 30-point drop, followed by previously about 50 or so points lower. That's a magnified move, right? It's a pretty extensive move up. And then as we're trading now, understand that this zone has some context, has some meaning, right? So then now that I draw it and it shows interest because we have magnified moves off of it, question then becomes, what has there been prior action here? Is this something that's new, or is this something that's been going on? Because we may have something prior, and this is the second segment of the video. First reaction, we found the reaction. Now the second segment is historically in the prior months. Is this a prior month high? Is this a prior range high? Is this a prior week high? Is this a prior daily high? Is this a prior FOMC high? What is it? Like, let's get some context. Let's form a narrative here as to why this level might be important. So I go back and you can see here from a couple weeks ago, I think it's September, yeah, beginning of September, to no surprise, this zone was also a multi-day high, right? We're looking at, let's see, I'm just gonna, again, we're eyeballing it here. We're gonna get into the exact precision into it once we start doing the next segment of videos into how to formulate a plan. So make sure you subscribe. There will be a playlist for this. So you can see here about 1, 2, 3, 4, 5, 6, 7, 8 dailies. We had an area where price just pretty much topped out right there, right? It tapped out a few times, faded back in. We were in a range more or less, but it was a week, maybe 2 weeks worth of level of interest. Yeah, about 3 weeks almost of a high. So that was almost a monthly high or a multi-week high, right? So the zone was give or take from 57.23. Tip of it was about 30s, give or take, right? Give or take there. I'm just eyeballing it. Okay. This is why I create zones. I don't create levels. Plans. So given that context, right, the reaction to move in the most recent auction, then we zoom out and we see there's also a correlation. The second part of the formula is where does this level line up on the bigger time frame? Well, it used to be a multi-week high from 3 weeks ago. So definitely of interest if we come back into the zone. So that's how I utilize reaction. Now we have time confluence, right? Time confluence meaning prior, was it a prior day high, prior week high, prior overnight high? Um, some people say oh, Asia or London session high, whatever. It doesn't matter. Point is that there's another element here that's giving me validation for the level for me to be of interest. So in this case, again, recapping once more, just to nail it in your head, reaction to move. Previous multi previous previous multi-week high, right? From the reaction to move we had in September from the sell. And so that lines up. They've got another correlation. Now, the third element that I love to utilize, if it's there, is this an event-based level, right? In the most recent auction, has this level or zone resulted in a reaction due to an event? In this case, it did. And if you refer to my Substack, and I'm going to refer to it right now, not only was it a multi-week high, FOMC high zone, right? It was a high zone, not a high exactly because the 55 was the high, but more or less high zone. That gives me more conviction in the trade. That's another element, another layer of validation, right? We're talking about focal points of reference for these levels to be relevant. And so with those three things, I found it to be worthy of creating a plan around all those things to identify a proper level. So again, just recap that once. I'm going to do it again with the NASDAQ on a different level of interest that worked out perfectly. I actually gave this trade in the live stream from Friday. So if you wish to look at that, feel free to tune into the most recent live stream. From OPEX Friday is the name of the video from September 20th live stream. All right. All right. Now we're on my NASDAQ monitor. All right. Welcome, guys. So on here, you can see, and I like to color coordinate my levels, okay? So that way they just stick out like a sore thumb and you just can't miss it. So that's a little bit of a tip there for you. I do that on the ES as well. Let's actually dive into that before, just to give you guys more, because annotating levels, like we get stuck sometimes in the muck of every single movement and whatever happens, something exaggerating happens, and we lose sight of the macro picture of what we're looking to accomplish. So I always make sure for me personally to not lose sight of what I'm looking for and what I'm doing. I make sure I color coordinate my levels. So and even make some notes, right? So if that helps, a little tip there for you. I color coordinate them. I have a special way of color coordinating my things and writing notes so that way I can quickly analyze what's happening. Should I be reacting here? Does this mean anything to me and my plan for the day? Because not every trade is meant to be taken in a given session, especially if it's not coinciding with an area of interest that you have. So here I'll color coordinate mine like kind of like an off yellow. Now I'll make sure to write 2-day breakout, write some notes as to how relevant this level is. Same thing you'll see here. Bear below, no lower, right? Coinciding with my Substack plans. If you guys want these plans, subscription, it's in the description there. I go over these plans every single day. I give as much context as possible, giving you the parameters of every single trade. But the goal with these video series is to formulate, kind of reverse engineer how I come up with these plans, because most of them do work really well. If you guys want to review them, feel free to check out the website. And the same thing you'll see here on my NASDAQ charts. I have different levels of interest, all color coordinated on higher time frames or lower time frames that I come up with. So on here, we're going to go to the level of interest, which was the 19K 900 on the NASDAQ, right? This little zone right here, I have it colored. Now, the NASDAQ does trade very wide spreads, right? It's not a very clean zone creating mechanism. It's very wide, so I remember someone said I have 19,920, so they had like around here a level, right? And ultimately, I mean, to be honest with you, it's a rule of thumb. The fucking NQ does not trade within one 5 point spread. Anyway, it trades within 20 or 40 points, and it loves. This is why understanding the mechanism that you trade, the asset that you trade, its tendencies, it loves to overrun levels and then come back in, hold them, and then run. Right? So the ES is a little cleaner in terms that it will usually come into a zone and then bounce. Right? This is the level of interest. The NQ loves to do this. Right? If you guys ever run into this, you have, oh, well, I'm going to buy it right here. The NQ goes, we're coming in. And then it comes back, and then it holds it, and then it runs. Right? The NQ loves to do that, where it just like runs over liquidity and then comes into the level, and then now you take the trade, and you're like, well, fuck, all I got to do now is break even after this little loss. So once we come to that understanding, it's best to just let the Nasdaq do its thing, right? Give it some time to be able to prove itself that that zone you have is actually of interest. And the way I like to do that is let it come in there, right? Let it come into the zone, let it trade into it. On the video that day, I said on the live stream, I like the 930. Well, what happened with the Nasdaq? What did it do? I didn't trade it right at the zone, but it literally puked right into it, puked all the way past it, started to trade right below it. And then that 920 level was actually pretty good for that gentleman who pulled it out, Peter. Shout out, Peter. 920 held above, retested, ran. Mine was the 930. So the long at 930 literally popped for a good 30 points and then came back, retested, and ran for about 60 to 70 points, ultimately leading up for almost a 100-point pop from the 930 zone. Now, how did I come up with the zone? It's very simple. Same mechanics, same information that I did to you find the ES trade. Go back to this time frame just because it's bigger. This was where we broke down from, right? This zone right here, highlighted, had a magnified move. And we had been trading this level, fading, traded it, faded, traded it, faded, ultimately gave up, puked, and came back down. I wrote here we have backtest, meaning that if price holds certain levels, we can backtest the level and come back and trade 930 again. Now, if you guys want to understand what I mean by backtest, what do I mean by reversing, well, follow me on Twitter or Substack. I have posts that discuss backtesting and what those mechanics entail, how to identify backtest zones. This is not a video for that, but I will be making one. The idea was here, okay, we overran the backtested level. We didn't just backtest and retrace. Ideally, when a backtest level hits, that's usually you hit it, you come back lower, and then you come back and hit it, and then maybe accept below, and then break out. Well, in this situation, we didn't, so completely overran the level. My assumption was if we come back and test it from above, just like the ES did at the 535, it broke out of the 535, and then it came back and back tested it, and I found the long. The NQ had the same thesis. The fact that it overran this level, it didn't even respect it on the way up. It just overshot, let's just say. I was looking for a backtest of the zone. And not just simply a backtest, but a backtest and reclaim, right? Now, what I mean by that is for it to trade the level and then come back and trade back above it, find some acceptance. In other words, trade sideways at the area, right? So just kind of break back above and just consolidate above to show me that that level is important and that they do want to respect it as a pivot for a potential trade to the upside. So that is the same thing in a nutshell. There was no fundamental outlier as far as like a event-based level. It was just a series of where we had broken down from. Again, this is why I make notes on my charts. We had previously traded here overnight, rejected at the open, came back, tested it again, tried to break out, put in a lower high, couldn't break it, attempted one more time until we finally puked, right? And if we really were to get into the mechanics of what this is probably going to be a CPI high. So that adds another layer of validation to the zone, right? There was a CPI print that happened on 9/3 that made this high, and then we ended up failing and breaking down. So if I were to add that layer of confluence to this level, it would add for me more validation to the trade or the level to give me conviction that this level is important. This was a prior CPI high. We had CPI data, which is really important to the market right now, and we're trading above that zone. What is that telling me contextually as a trader? Just like the FOMC high, right, on the ES, it's telling me that all the data that was collected by the market and all its participants at the FOMC data release, we're trading above that level where we rejected and sold off from. So anybody who's using that as a reference point, saying, okay, we're at the FOMC high, yesterday's high, I'm shorting this bad boy. Well, that means there's more interest, more volume transacting there, and that if we actually don't sell off below it, there's there's a greater chance that there's a squeeze or a magnified move in the other direction because that level is being utilized by other traders, right? Other traders look at the FOMC high, CPI high, PPI low, whatever the level is, and they use it as a reference guide to short or long against. And the more perception there is on a level, especially if it's an event-based level, the greater the magnitude of the move. So if you made it to the end of the video, you have a golden nugget that I don't think many people pay attention to or utilize in their trading strategy when identifying price levels of interest. So congratulations for watching the whole damn thing, because a lot of you guys don't have the attention span to get this far. What I'm going to do here is just recap the 3 reasons again, just for sake of simplicity, so we have something to kind of walk away with for the day, and maybe hopefully help you create your own plans going forward. So first is reaction, right? That's number 1. Number 2, time-based, time-based level, which means is this a, so it's 2A, is this a prior pre-month high, week, day, overnight, whatever, right? Time-based level. The second thing is the last one, which I love to add if I can get that level added to it, the confluence, event-based level, right? Is this a, again, just as an example, CPI high, low, is this a FOMC high or low, right? And because events are very volatility driven, they're never going to be one level. It's always going to be a zone. Okay, so just keep that in mind that because volatility is really high and price has a tendency to skip price levels and go up and down when there's volatility, it's always going to be a zone and not an exact level. The reaction and the time-based levels can be a little more condensed, right? Within a 5-point spread. When they come to event-based levels, they're probably going to be a little wider, right? So it's harder to be more precise on these. But if they coincide, if all these things coincide, all these 3 things come together, then you have yourself a formula for a pre-market plan. And the next segment of this video, stay tuned, will be playlisted for how to use these levels to formulate a structural idea. Not a plan, just a structural idea on how to execute, okay? The next segment of videos will be on that. Then will be execution. Where is your trigger for the execution? Where is your stop loss? And then the last thing will be management, where to take profit, and then the emotional aspect of all this. So you got to stay tuned, you got to subscribe, and you got to follow me on Twitter. All right? See you guys in the next one.